why I wanted to touch on this was I put this tweet out pretty late on Friday. I was trading the oil quite late, and what it was the CL is showing very clearly that right now we have a seller engaging at 54.11. Okay, so very, very important. It wasn't me assuming, it wasn't me looking at the price ladder, it was just simply observing what was happening on the footprint, okay, which was someone keeps engaging at the highs. Okay, so I said we can see this with the blue-red delta switch. So we have a blue delta, red delta, blue red delta, red delta, and I'll show you this on the footprint in a minute, so don't worry. Okay, and I said it's happened the last 3 times we've actually attempted to rally. So what I was saying here was if that changes, if suddenly we don't see that selling in the 4th time, okay, we want to buy and hold, targeting 54.90. Now, the important thing to take away from this, I think I got a little bit of stick for this, and I'm all for people expressing their opinions, and I encourage it because that way you're always forced to think a second time, and that's why I want to share this with you. Okay, in essence, I had someone reach out and say to me, "Do I not think it was the wrong trade? Was it not overly aggressive? Was it not looking for too much, given what had happened in the oil scenario, etc." Now, what I want to highlight is that there's no such thing as really wrong or right in trading, okay, and that's very, very important to highlight because a lot of traders seem to think there's right and wrong. There isn't. There's high probability scenarios and there's low probability scenarios. Everything boils down into ultimately what you're trying to achieve and what the risk reward is around what you're trying to achieve. Okay, so as you can very clearly see, what we're looking for here is we're looking for a good 80-tick rally. In terms of risk, because this is a breakout trade, we can keep that stop relatively tight. Why? Because we're going with the momentum. Right, and that's what I'm going to take you through, as we go through this. Now, the principle we're looking at is how do we execute and what are we looking for when we have these macro events. So I'm going to start off and go with the macro event, i.e. the announcement. All right. So we discussed last week about the preparation for the oil. What the market was looking for was somewhere between 1 and 1.3 million barrels. Now, in essence, we actually topped that estimate and got slightly higher. So the market almost got a better deal than ultimately what it had kind of been pricing. And that's why what we got was a very aggressive bid up. So when that news hits the market, okay, one of the hardest lessons I ever have to learn is that when information hits the market and it must reprice, you have to be aggressive early. Okay. As the market starts to move, it obviously reprices that information and the edge disappears with every fraction of a second. Okay, so what we're looking at is ultimately being aggressive early when that news hits. Look for that aggressive move, that search of effective fair price or fair value, and once it hits that point, we're looking to liquidate our positions. Now, one of the things that a lot of the Axia traders do particularly well, and again, I always like to say the Axia traders simply because I don't class myself as being very good at these types of trades. Okay, I tend to overthink them. All right, I am someone that probably overthinks a little bit too much in terms of risk. Okay, so but what a lot of traders do very well is they have this expression, hit first, ask questions later. All right, and that's again, a lot of people say, oh, edge is knowing this and edge is this. But actually, sometimes edge is just having a simple mental philosophy of hit early, ask questions later. Okay, and the reason I think it is edge is because the traders that adopt that mentality make a substantial amount of money because they're hitting these things very aggressively early, they're managing a very tight risk, and they're making substantial amounts of money. So, again, the key lesson to take from this is that don't look at edge as something that is definable, that is metric, that is a pattern. That's not necessarily edge per se. Edge is anything, absolutely anything, that can allow you to outperform against someone else in whatever context. Okay, so just have a deep down think about what that means to you, because you might actually find that your edges might not be technical analysis, they might not be news fundamental analysis, they might just be that you're able to focus for longer periods of time than most, you're able to manage risk better than most, maybe you're able to sit on trades for a couple of days better than most. Find that edge, maximize it. Okay, so that's the first thing we're looking for, is that order execution. We're looking at that very aggressive bid up. And again, I'm going to show this to you in a chart in a minute. Now, once that risk is out of the way, the really good traders are the ones that take advantage of the patterns recognized within that risk event. Okay? What I mean by that is when there's volatility, by the very nature of volatility, price obviously shifts. Now when price moves, it brings in more and more participants. That's why when you have very big price movements in the market, you tend to get very high volume. Why? Because more and more people are forced to act as price changes. Okay, that means there'll be more and more patterns to recognize. Now, the important thing, and this is why I love the footprint, is once you get these big risk events, once you get these volatile moves, there's so many great observable patterns, and I'm going to show you what these look like in just a second. Okay, so what we're looking for in the footprint is we're looking for things like relative change, we're looking for subtle shifts, we're looking for changes in patterns, we're looking for changes in execution. Okay, we're looking at all sorts of different changes, something that's telling us this was happening in instance ABC, now suddenly it's happening in a different way. Okay, it's when that change occurs, that subtlety, that's the nuance, that's the clue, that's the hello, time to do something. Okay, so let's go through the example. We are looking at obviously, Friday the 7th of December. This is the WTI oil, so it's CL on your trading technology ladders or CLE on the CQG or whatever you might be using. Okay, now the first thing I want to do is I want to get up a 5-minute chart, because this is traditionally what most people would be utilizing is some sort of a 5-minute chart. Okay, so what we've got here is a 5-minute chart. We can see it there. Announcement comes out around about the 1 o'clock, or in fact this wasn't an announcement, this is just more a little bit of noise. Okay, so we get a little bit of noise, we can see the volume picking up. Now straight away, guys, this is where knowing your metrics counts so much. You can very clearly see, if I scroll this further back, 25,000 is a substantial amount of contracts to do in 5 minutes. Okay, each one of these is a 5-minute candle, obviously. Okay, so 25,000 contracts is substantial. Right? We then follow it up in the next candle with another 25,000 contracts. So straight away we can see there's something in the market. Yeah, there's something that someone knows. Now, like I said to you last week, the most important thing about OPEC is that it's always in the market before it's actually announced. Okay, that is unfortunately, one of the things you just have to accept. So it was already in the market. When it was officially announced by the wires, i.e. the Bloombergs, the Reuters, we were trading somewhere around this 52.69. Now, the key was that obviously the number was higher than the markets expected. So we needed a reprice. Now, this is the first thing we're looking for. We're first looking to attack and be aggressive and go with that, hit early, ask questions later. This is the first bit of it. 52.69 is up to 54. We're looking at about 130 ticks and call it 6 or 7 minutes. All right, so again, a lot of you might say, yeah, but that's not a lot of money, but it's not the point. Okay, the objective of this job is to extract ticks out of the market. It's not to run it for 300 ticks. It's not to call the low. It's to extract prices out of the market, and you want to do that with high degree of certainty. Now, when there's new fundamentals in the market, there's always going to be a high degree of certainty in terms of which way price goes. Warranted, it's not always straightforward. Warranted, it's sometimes scary as hell. Okay, but you have to find a way you have to find a way within it that you can ultimately make some money because the opportunity exists. Okay, the best traders I know are not the ones that shy away from movement. Okay, they look at a chart, they say the market moved from year to year, that's opportunity. How can I access that? How can I take advantage of that? All right, now what is important and what is key, and this kind of leads on to the next part of it, which is, why I was looking for that break, why I was looking for the aggressive continuation. All right, what we can see now is we've got some positioning in the market. We can see that 2 reasons. 1, we've got to pick up in volume, and 2, we've obviously got to pick up in price direction. Okay, so the volume is confirming that more and more participants are buying higher and higher prices. Right, that's showing us there's now a natural long position in the market. The second thing is we can see the market starts to consolidate. Right? So we spent a good almost 2-3 hours just consolidating in a tight little 60 tick range. So we have positioning, long positioning, and consolidation. Right? Now straight away that says to me that at some point, right, if these buyers are just holding prices very high, at some point the selling is going to give up, it's going to stop, they're going to stop providing liquidity, and the buyers should then become aggressive again. And that's what we were looking for. What I was saying in the tweet was we had 1, 2, and 3 attempts at the high. 4th time, okay, if we see the market go bid and we see it hold that positive delta and not see the sellers engaging, we should then get a continuation up to 55.90. Subsequently, what did we get? But up, straight back down. One last test, and eventually the market just rolled over. Okay, now let's go and look at that footprint. Let's look at it and look at some of those subtleties and see if there was a trade. Okay, this is the real clue. Was there ultimately a trade? Now, I'm going to just quickly go through the 3 examples so I can show you what that engagement looks like from the seller. So straight away, we can see the first attempt at it. The first time we came up to this 54.10, notice what we get the very next rotation. I'm just going to make this smaller. Okay, the very next rotation, negative 800 delta. Now note the delta on the day was only 1,000 positive at that point. So again, we can see those sellers engaging, hitting the bids, really showing the market that there is some selling there. Okay, it doesn't mean it's a sell, doesn't mean, it's time to get out of your longs. It just simply means there was a seller engaging. Second time we came up, again, note, positive 800 delta, test the 54.11. What do we get in the next rotation? Minus 360. Okay, so twice we've come up, positive delta, and the sellers have engaged. We come up again, buyers engage, get aggressive, sellers engage. Okay, we then came up a third time. Notice the positive delta. What do we see the next rotation? Negative delta. So 3 times we've seen positive, negative, and positive, negative. Okay, now the key thing to show is that it's not a small negative. Okay, if this was sort of minus 90 or minus 50, I'd say okay, fair enough. Nothing really going on. This is quite substantial. Right? More importantly, we can see the buying pressures building. We can see that not just once, but twice the market's starting to be bid up again. The buyers keep buying and they keep holding it up. So the buyers are building the pressure on the sellers here. But every time the sellers respond. Now, this is where the key came in. What we're looking for is the next attack. We want to see that delta stay positive on the break. We want to see get through these 54.11s and post the blue number. Show us that the sellers aren't engaging. If sellers aren't engaging and we're in a flag type formation and we know the buyers are positioned long, that gives us the edge to be looking for continuation. Okay, it's not about whether I think oil was going up or down. It's not about what the OPEC said. All it comes down to is what the buyers and sellers are ultimately doing. Okay, we can see 3 times I've shown you the example. The buyers engage, they take it to the high, the sellers switch over, and they smash it back down. Not once, not twice, but 3 times. Let's see what happens the 4th time. Okay, again, buyers come up, take it all the way up, and what happens? Okay, very next rotation, not only do we get the negative delta, but we also get the price response. Okay, and that's the real key. It just, at no point could these buyers, even if you look at where this, positive rotation closed, it bid up all the way from 84s to 21s, and in the same rotation, closed down at 84s. Okay, almost a 40-tick reversal in a space of 5 minutes, just showing us how much pressure those sellers were holding, every single time we went up there. Subsequently, we went up one last time. Guess what price holds? 54.11. Look what happens to delta. Negative, 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 negative. What's the conclusion? Conclusion is very simple. Okay, we prepare for these things. We take the risk events. We look for the patterns that exist. We try and take these opportunities. Try and take advantage of them. Okay, as traders, we've got to do what makes sense to us. Right now, for me, this breakout makes sense. The important thing to understand, guys, and this is kind of what I wanted to get across. I was questioned on whether I was right or wrong pitching that breakout to the people that follow me. And the simple answer is, 100% was I correct in throwing that observation out there. Why? Because it's an identifiable observation. Okay? The important thing, and this is kind of where I had to think quite a bit, the important thing for me is that I also need to always ensure that you guys understand what sort of a time frame I'm working on. Okay, so going forward, I always want to just express my tweets a little bit better. What I'm looking for is I'm looking for fast money momentum. I'm looking for that momentum continuation. If it's not there, I'm out. Okay, in terms of this trade, I probably took a scratch, if a small loss. Right? Had it gone, I'm looking at 50, 60 to 90 price winner. If I'm wrong, I'm taking almost a scratch. Now, if you run that same time frame, right, that's the kind of trade approach you want to be looking for. If you're not, if you're more of a swing trader, someone that likes to hold smaller positions for bigger winners, that's fine too. 100% that's fine. Right? You will just be looking for slightly different indications. The lesson? The indications were there. The lesson is that there was something to observe. There was a pattern that was recognizable. Did that pattern change? No. Okay, and that's the key takeaway. That's the key lesson hopefully you can take away from today. Now, going forward, it's obviously Monday evening here, and we can see these 54s are holding like an incredible fortress. But we know now, 54.11, look how much we've paid for this information. Guys, we get to this 54.11 again, and that, we see those buyers engaged there with no selling. It's got all the upside potential. We're talking 60 to 100 prices of fast money. Use that information. That's my last lesson for you guys today. Yes, you might have lost money on that breakout, but never lose the information that you paid for. That's what the good traders do. They store that information, they come back the next time, and they make it all back and some.